because Bollard started cutting interest rates, the OCR, at the beginning of, or in July 08. You can see the 5-year swap rate, the grey line started to come down. You need to sort of add the credit spread to the wholesale rate to get what the bank funding cost is. And you can see the black line, that's basically it. So, okay, it come down a long way. Retail interest rates actually fell. Now, more recently, in the last 2 or 3 months, they've been going up. And you're thinking, but the credit spread's narrowing. Why on earth are interest rates starting to go up again? And it's because the wholesale curve itself, people are starting to see recovery, see inflation down the track, and so depositors globally are wanting more compensation for that in the 5-year space. So you're seeing the actual cost of funds, the black line, rising, even though the credit spread's been coming back in. Tough. It's complicated, right? I'll move on. Likewise, for short-term borrowing, certainly the Lehman Brothers collapse. You know, the beginning of the credit crisis was scary. Lehman Brothers meltdown and the run for cash at that point got short-term interest rates, or at least the spread, the risk factor going through 300 basis points, like 3% more on short-term money. Exactly the same deal. That is now starting to come back in, but the outright interest rate curve is now starting to lift on expectations that interest rates will be lifted at some point down the track. What's domestic banks doing for agriculture? Or maybe put another way, in the media, would be banks aren't lending anymore. Absolute load of rubbish. Credit numbers from the Reserve Bank show that credit growth in New Zealand is well and truly positive, unlike elsewhere, especially the UK, where credit is contracting. And to agriculture, on a year ago, total across the banking sector, 22% growth, I think it's 21% growth now, on a year ago. So banks have lent 21% more compared to 12 months ago.
Just capitalising the interest, don't you?
What's that?
You're just capitalising the interest, don't you?
A lot of it has been expansion of overdraft, rather than necessarily new investment, as you would expect, but that's exactly what you'd want the banking system to do, that when times get really tough cash flow wise, expand the overdraft and allow the funds to be there, and there's been a huge expansion over the last 12 months. Not so much in households, not so much in business as well. Certainly it's a two-way street. You know, banks, have to be willing to lend, but there's got to be people actually wanting to borrow money. You know, especially in the household sector in the last sort of 12, even 24 months, there hasn't been that much demand for housing and or cash for houses. So maybe it's just the demand side as much as the banks tightening credit conditions. But certainly a big expansion in agri-lending in the last 12 months. Okay, so fiscal policy, government's been spending out large bailouts and what have you. I think the much bigger risk than just the decline in world output of 2% is the increased protectionism globally. The US and EU dairy subsidies, case in point. These things, you can sort of handle, it's tough, but 1 year income decline, it's much more devastating when you get these policies put in place because they take a long time to get rid of. And I think from a New Zealand perspective, that's a lot scarier than just the world contracting for a year. It's the fact that you're going to have years of increased output over and above what market conditions would dictate. And that's the real bad news in this. I think if there's one thing we learned from the Great Depression is that shutting down trade and or putting out protectionist measures amplified at no end. Let's not go down that route again. The problem is we're starting and that's not a good sign. Won't talk about that because we're short of time. Quickly, New Zealand economy. 2009, obviously the credit markets. We think 2010 there will be mild recovery, lower interest rates, and hopefully a lower New Zealand dollar. It's certainly better than 80, but at 64, 65 is not going to help much. Net migration is certainly increasing heaps at the moment, the last few months. That will stimulate some activity at home, but really it's 2011 before we see above trend growth. Really the lagged impact of the policy starting to work, and I think it's all about, internationally and in New Zealand, it's all about balance sheets at the moment. They've been absolutely smashed, asset prices have fallen, and cash flow, it takes a long time to repair balance sheets from cash flow. So really it's going to be quite an extended sort of drawn out process of recovery, and really it's not until 2011 before we see above trend growth. Net migration, just while I mentioned it, starting to rocket higher, as it did after September 11, by the way. When the world looks really scary, Kiwis stay home and Kiwis come home. This is not about more foreigners coming in, this is about Kiwis now not leaving, either to the UK or to Australia. Quite a rapid increase. It does have quite a big impact on the housing market, and we certainly see some support there, not only in the housing market but activity generally. GDP growth in a picture, that's the down and up. Labour market, I think economists, most people will be thinking, when we're talking about recovery in the last quarter of this year for New Zealand, people will think, oh man, they are on another planet again. It will feel a lot worse in 6 months or 12 months' time, even though economists are talking about recovery. We'll be talking about GDP starting to increase, but it's come from way down here. You're still feeling a real low level, whereas growth has returned. Unemployment, the labour market will be a lot looser, so unemployment will rise. We think it will go from the current 5% up to and above 7%. That won't feel good in 12 months' time, even if the recovery process is starting to kick into gear. I guess from a positive spin on it, 7% unemployment is the same as 93% employed. Not everyone is losing their job, and there's certainly there's something to be taken from that. And from a business point of view, if you're actually looking for staff, it is going to be a lot easier to find, and the quality of applicants are going to be a lot higher. So if there is a silver lining there, that might be it. But it's not going to feel much better in a year's time, I don't think. Probably worse, even if economists are talking about recovery. Really, it's the 2011 above trend growth, unemployment starting to fall when we'll actually feel better, if you like. That's something I mentioned, New Zealand's current account deficit. This is the Achilles heel. This is why the Kiwi dollar needs to be lower. Why isn't it lower? One thing I didn't mention, you could take it from a perspective that we're in the right stuff, we're making food. The medium-term picture for New Zealand is extremely good. Relative to the rest of the world, we are better. If the outlook's really good, why don't you buy the economy now, buy the New Zealand dollar now? You could view it as a vote of confidence in the economy and in what we're making. That's why the dollar's high already. The problem is it's a major balance between taking it too high too early and the recovery never coming. That's certainly the balance. And at the moment it feels like it's the wrong way around. It's like the green shoots. We're not there yet, don't buy the Kiwi, but people get a bit too excited, and I think at the moment it's too high to see genuine recovery coming. Anyway, we haven't run a current account surplus since 1972, I said. If you accumulate those up over time, you get this beast, which is the international investment position. This is New Zealand's international stock of debt to the world. Pretty nasty stuff, about 170 billion. It's about 97, I think we just had a number, it's 92 on this chart, 93% of GDP. It's got worse in the last quarter, funnily enough. Another current account deficit. This is sort of the risk factor for the Kiwi going down to that 40. Commodity prices lift, you can see it at 70. If the world actually worries about what debt we have on board, then you can certainly see the Kiwi dollar a lot lower. And that what makes forecasting extremely difficult at the moment. It's about the flow of income probably improving in 2010. Stock of debt still looking very nasty.
Excuse me, Doug, have you noticed me shuffling my seat? Is it a couple of minutes if you wouldn't mind? Just to keep on time.
Last slide. How about that? Positive. Got to finish with a positive because there ain't too much positive in there, eh? We are making the right stuff. I still think the emerging markets, the Chinas, the Russias, India, Brazil, Argentina even, if you go through Latin America, there's still going to be a lot of growth in the emerging markets. They're buying the stuff that we're making. Certainly, we are a lot more complementary to growth in China rather than competing like, say, the US or Europe. There's plenty of stuff we've talked about forever, the urbanisation, westernisation of diets. I think those things are still the 10 and 20 year sort of story. That's why the Kiwi dollar will probably go through 70 and 80 in 10 or 20 years. But for now, it's a pretty tough time. But the medium term still looks pretty rosy from a New Zealand export agri-economy point of view, I think. That says, don't listen to anything I just said.